In this video, we walk through Handout 11-1, some basic common stock transactions. We're going to issue common stock, reacquire shares, which we refer to as treasury shares, and then subsequently reissue those treasury shares. We're told that Straight Corporation sold 5,000 shares of $10 par value stock for $30 on May 1st. So we're going to have a cash outflow of $150,000. That's 5,000 shares at $30 per share. So we have an increase in assets and we will have an increase in equity. Now we record common stock transactions at their par value. So we'll increase common stock by 5,000 shares times $10 per share, or $50,000. Of course, debits don't equal credits, so we will also record an increase in what we refer to as additional paid-in capital. In terms of our journal entries, we increase cash with a debit to cash, and we're going to increase equity accounts common stock with a credit of $50,000 and additional paid-in capital with a credit of $100,000. Next, we're told that on December 1st, Straight Corporation repurchased 1,000 of these shares of stock on the open market when it's trading for $27 per share. So Straight will have an outflow of cash, a decrease in cash of $27,000. That's the 1,000 shares times $27 per share. And of course, accompanied that decrease in assets, we're going to have a decrease in equity. And we're going to use a contra account. Rather than decreasing directly common stock or additional paid-in capital, we use a contra account called treasury stock. A contra account simply will reduce equity, just like our allowance for doubtful accounts reduces accounts receivable, accumulated depreciation reduces net plant, property, and equipment. Our treasury stock account decreases stockholders' equity. To record these journal entries, we record the decrease in cash with a credit of $27,000. And of course, the debit to treasury stock will decrease stockholders' equity. Next, we're told on December 15th, Straight sold or reissued 100 of these treasury shares for $32 per share. So Straight will receive cash in the amount of $3,200. That's the $100 per share times $32 per share. Since we have sold off some of our treasury shares, we want to reduce our treasury stock by the 100 shares times the $27. That was the price we paid to reacquire the shares in transaction B. Of course, debits don't equal credits. We'll have an additional increase in additional paid-in capital of $500. We record the increase in cash with a debit to cash, and we record increases to equity with credits. So we will credit treasury stock for $2,700 and credit additional paid-in capital for $500.